Hello, this is Doc's Market Minute for Monday, the 17th of January. It seems like no matter where you look these days, investor sentiment is negative. Between Omicron and inflation readings, a lot of investors are starting to talk about approaching a bear market. Is that true? Let's take a look. Here is the S&P 500 chart as viewed by the S&P 500 futures, or the ES contract. And to me, this is the most accurate view of looking at the S&P because during the trading week, it encompasses almost 24 hours of price action. So we see all the warts, all the overnight action, everything, including, of course, the market during the cash open. Now, the way I've got this split up here is I've got the monthly chart on the left-hand side, the weekly chart in the middle, and then the daily chart here. The reason that I use these three time frames, these are separated by approximately a factor of 5. There's roughly 5 weeks in a month, and as we know, there's 5 weeks in a day. So what we call these is a chart that's 25 times the daily chart, 5 times the daily chart, and then, of course, 1 time the daily chart. This is our signal chart here. And the way we're going to use this is a couple of different rules that I have as defined by fractal energy trading. Rule number 1 says that larger time frames dominate the trend. We can see this in the case in the monthly chart, and even in the weekly chart, we see this higher highs and higher lows being dominant. So every time that the daily chart pulls back, has the effrontery to pull back, it gets pulled back in the direction of the larger time frame trends. That is rule number 1, larger time frames dominate the trend. However, this brings up rule number 2. If and when we do reverse into a bear, what we're going to see is that reversal is going to come from the inside out. So reversals start from the inside out and they propagate higher. So if we do see a reversal to a downtrend, we will first see it on the daily chart. All of these are higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and now we have a lower high setting up. Now that's not necessarily the end of the bull market, but what it could be is the beginning of a potential reversal. If we do have the price closing down below last week's low, which was on a Monday, then we do have a change in polarity to a downtrend, and that starts the process. And this could start the process of a downtrend where we have the weekly chart now showing a lower high and a lower low. And that eventually will infect the monthly chart if this is a really bad one, and that too will have a lower high and a lower low. Now, quite honestly, I'll put it this way, we have not seen a true transition to a monthly downtrend for a long, long time. About 14 years now is the last time that we saw that. What we've seen since that point, what people call bear markets, have just been very sharp corrections. Even the one back here, back during the pandemic, was nothing more than a severe correction, which easily got past the 20% bear market mark, but never truly transitioned into a lower high, lower low in the monthly chart. So this is what we're getting these days, and this is due to the quantitative easing and the easy fiscal policy that we've seen. So a couple of points for today. Number 1 is that bear markets play out over several months. In fact, they usually take 18 months to 2 years to play out. So we may not necessarily see a bear market. However, we could get a very scary correction in the short term. Now, a correction is represented by about a 10% haircut from the current price. You can see here, if we start about 4,800 on the S&P, a 10% haircut from there would be somewhere just above 4,300, somewhere down in this area. So we would see a retest of the 200-day moving average, which we have not seen since the summertime of 2020. This is a long time for the price to be away from home. This green line here is the 200-day moving average. And we would also fill these gaps which are represented by all these upside gaps that were created back in October. If we were to see a move down to 4,300 at this point, I believe that this would cause eventually, after a bottoming process, a hellacious final move for this bull market. I think we would see the final finishing move to the upside. Markets rarely just drop from the highs in this quiet manner like they're doing right now. Usually what happens is when they drop like this, they're getting ready for a correction. So perhaps we will get a correction in the near future, but I think ultimately this would lead to a huge blow off. Now, you got to understand that if we do drop 10% from where we are right now, that's going to be a massive amount of negativity into the market. You're going to see all the pundits out there getting bearish. Everybody's going to be getting ready for a bear market. It's not going to happen. If we do get a correction in the short term, I believe this will ultimately end up much, much higher into 2022, probably second to third quarter if this correction does happen in the first quarter. Now, if we do get that blow-off move, all bets are off after that. If we do get that blow-off move, more than likely, I think this will be the time where we do fall into a true bear. So my thoughts at this point is by the time we get to, if we do end up rallying higher, that will be the final move for this cyclical bull move, which started back here in March of 2020. So to understand what's going on the price chart, keep your head out of the news, number one, and number two, use those rules that we talked about. Rule number one, larger time frames dominate the trend, but reversals start from the inside out. That's rule number two. Have a great day. Thanks for listening.